Nath, who's also joining us now, the management, the MD CEO of U GRO Capital. Shachindra Nath, very good morning. Thank you very much for your time. Where is this massively explosive growth coming from?
Ajay, as I've been saying for a few quarters now, that U GRO, which set up its base in 2018, it used the downtime of COVID to build massive infrastructure. It has grown from 120 people to almost 1800 plus people, 9 location to 100 plus location. Our digital technology infrastructure went from 5 people to 275 people. Now, so that base is maturing. And as we have said that in March, we reached to roughly around 60% of our installed capacity. We did almost 500 crore of monthly run rate in March of current year, and we planned that we'll maintain that run rate for the whole year, and gradually by every month it would keep increasing a little bit. So actually, it is just coming from that. I would say that the early effort of putting one of India's largest digital plus physical infrastructure for small business financing for customer segment of 25 lakh turnover to 10 crore turnover is playing out well for us.
Just a quick follow-up. I want to understand what is the mix looking like? What is the client mix? What sectors are they coming from? Or do you have exposure to one particular sector higher than others? Or have you distributed that risk very well?
No, so we look at this segment of small business customer, which is 25 lakh to 10 crore turnover. We look through the lens of obviously the machine, what we call the GRO score. When we use GST banking and the bureau, and there is an algorithmic method to we score our customers and say yes and no. Under that, we have decided or we have designed our business to be focused on 9 sectors and 100 sector. So which is healthcare, education, largely India's consumption market. And our portfolio are spread across these sectors. So there is no one single sector which is actually contributing more. And third, we look at by the customer need and the product type. So as you know that we do secured prime customer in top 25 location, we do micro enterprises in 75 locations, we do productive asset machinery financing. We have now entered into in the renewable and solar rooftop space. We are expanding actually quite rapidly into what we call solving the problem of credit for the retailers in India, which is linked to a large ecosystem. So our digital merchant lending app is also now gradually started picking up. So it is across our 9 sectors, across our 150 plus subsectors, across geographies and across product line. So I think so we are becoming a prominent force to solve the problem of credit for this customer segment.
Shachindra, I mean, can we expect you to achieve an AUM of, say, 20,000 crore in the next 6 quarters? Is that a fair assumption?
Well, we have been, very, very open about what our long-term aspirations are. I've been constantly advised that no listed company should give forward numbers so aggressively. But I think so, we should be in that range for sure. The way you should look at it is that we started April at 500 crore monthly run rate. We exited at 6,000 odd crore. You add our 6 to 7,000 crore of disbursement, and that's why we should be between 9 to 10,000 crore this year. Our natural progression would take us to around 700 crore of March exit run rate in March 24, and now we're adding a little bit more infrastructure. So we're adding around 75 physical location. We entering 2 new states, which is UP, 3 new states, UP, MP, and Andhra. And hopefully by first quarter, this run rate should increase to around 900 to 1,000 odd crore. So theoretically, we should be at around 18 to 19 to 20,000 odd crore by end of next year. But more importantly, I think so, the reason why a company like ours have been able to get to that scale, because we have changed the spectrum of lending by NBFCs in India by being the prominent and more forceful partner to the large banks, both public sector and private sector. And our AUM or the gross disbursement, 50% being now co-lended by the bank, is a game changer for not just for us, for the entire industry. So gone the days, or I think so in next 1 year or so, you will see that NBFC's perennial problem of how to fund their asset and how to get the liability is massively getting solved. So the trust institution, which are the bank, which are the owners of the liability and the public money, and that power is now getting translated to us and getting translated to millions and millions of small businesses in India.
So tell me, what will your mix look like by FY25 if you could break it down between secure and unsecured book?
So first and foremost, I think so we don't differentiate customer, and obviously the market looks secured and unsecured. We look at cash flow of the customer, which comes from this this data design of GST banking and bureau, and we are doing a lot more other than. The collateral actually only defines the tenor and the pricing. But we also believe that there is a conventional wisdom in what we call yield to loss ratio curve. If you lend to a customer which is a secured borrower at say 11%, you'll have a 0.25% loss. If you lend a customer at 40%, obviously you'll have a 8 to 10% loss. And that's why our distribution and asset engine create that mix. We want to maintain the blend of 70% of secured asset and 30% of what we call the business loan. But I must remind you that all of our business loan, a majority of that are also guaranteed by CGTMSE. So 75% of our unsecured loan are guaranteed by the credit guaranteed trust. So to some extent, they are also quasi-secured. Within that band of 70% secured, we have secured by property as collateral, we have secured by machinery as collateral, we have micro enterprises, micro secured loan, we have supply chain finances, where then some sort of support from the anchors. And then we have what we call the channel, which is our Grow Extreme platform, where we have 75 plus partner, wherein there is some form of credit enhancement coming from the partner. So I think so we have created a very, I won't say complex, but very diversified mix of how do we maintain and sustainable basis a less than 2% credit cost. And that's a function of selection of customer type, selection of sector, subsector, and also construct of our portfolio.
What's the outlook then, Mr. Nath, when it comes to the overall asset quality trends as well that you're seeing in co-lending and the partnership lending model?
So co-lending has two parts, ma'am. One is what we do with the banks on the liability side and what we do with other small NBFC and fintech on the asset side. So, so our asset block, whether that is being lent by us or that is being co-lent by banks, there's no difference because they are neutral to that. Banks is just a partner to fund the end customer. The trend which we are seeing from the which is roughly around 20%, 15% of our business with these multiple small NBFCs and fintech with whom we do the business. Obviously, that is very difficult to find the trend. Every partner has a different sub-segment, but broadly speaking, we are seeing much more improved, credit profile and collection profile vis-a-vis say 1.5 years back. And there actually, surprisingly, we are seeing some of the new generation, this is revenue-based financing, merchant lending, actually doing fairly well, which otherwise conventionally we have all seen or believed that they are fairly risky. But you have to be very calibrated because because when there is a lending without collateral, you can predict the default ratio for next 12 months, but you can't predict default for next 24 months. And that's where the collateral start playing a role.
Shachindra, one quick question. What is the sensitivity if your loan book by all these measures which you're talking about goes up 2-3 times in the next say 6 to 7 quarters? How much does it actually translate to profitability improvement? How is does the profitability increase in the same measure or slightly higher?
No, actually, that's fairly unique. I think so. I don't understand capital market, or I understand it very, very little. But I think so. The operating leverage, as you say, that this company started with 1,000 crore of capital. It built all of its OPEX upfront, and now starting April 23, most of our OPEX came to freeze, and that AUM started growing. And that's why if you look at our bottom line, is actually had a multiplier impact. So in 2022, we had a 7 crore PAT. In 23, we had 40 crore PAT. In Q1 this year, we had 25 odd crore. And we have guided the market where we should be in the range of 120 to 130 crore. And I'm fairly confident that next year, this bottom line should be nearly doubling from where we are. Because now our incremental OPEX is very limited. So for example, if when I add 75 or 100 physical location for more micro enterprise business, the cost of that incremental OPEX is not more than say 5 to 6 lakh rupees per branch. But the return profile of that, because a 20% secured yield business, it takes 12 months time to 15 months time to break even, is fairly significant. So the operating leverage or OPEX to income ratio now would significantly improve. So we were last year at 71%. Our target is to bring our income OPEX ratio to 45% and remain at that level for next few years.
Excellent. Thanks very much for your time and of course telling the roadmap of the company from here on as well.